Good morning from our global headquarters in New York. I'm Danny Berger. Manish Cranny on a well-deserved break. Welcome to Bloomberg Brief. Let's set your agenda. Autonomous dreams. Musk unveils Tesla's new robo-taxi, estimating that production may start in 2026. The data puzzle. Jobless claims at a one-year high and hotter than expected CPI. The Fed's next move remains in question. And earnings season begins. The big banks report their numbers, with JP Morgan and Wells Fargo kicking off before the bell. Well, it's a confused market, driven by confused data. We're in a period heavily influenced by storms and strikes. Hard to get a clean read. For this equity market, it is weaker this morning after a weaker session yesterday. We are off the highs. The next thing we do is we await reports from JP Morgan, Wells, and BNY Mellon, all before the bell today. Russell 2000 leads the declines. For bonds, still below 4%. The front end pushed below there yesterday. Yields up about 1 basis point across the curve, a little bit more than that. More concerned perhaps yesterday on higher claims data, but CPI did push up inflation swaps. Oil also weaker. You can see that on the bottom of your screen after a rally yesterday. Last night, Israel's Security Council met. It was up yesterday over concerns of what retaliation might look like. Well, Ella Hoxha, head of fixed income at Newton Investment Management, looking ahead, writing, "We have reduced risk substantially at the end of September and shifted from long to short treasuries." Ella, I'm pleased to say, joins us now. Ella, I want to work through this call. Let's start with risk. Why the reduction?
I mean, the symmetry is something that appeals to us, typically speaking, and that was the case around April or May. But here it's sort of, we would say, probably at best fair value for the front end of the curve in the US, and it's heavily positioned for. So we have the steepener trade, which is probably one of the most favored trades in macro community. And so that makes it tricky to have high conviction. So that's predominantly the reason. So we're a bit more fairly priced in rates markets now. And in terms of credit markets, they're also priced for good outcomes, broadly speaking. So it's difficult to push in any direction. So it makes sense here to have lower levels of risk, particularly given that we have quite a bit of event risk ahead of us over the next several weeks.
Yeah, that is like maybe even an understatement, Ella, just how crazy the next few weeks are going to shape up to be. How much of that of reducing on the front end is also about the Fed and their ability to continue to deliver cuts at a sizable pace and scale?
Well, I mean, visibility is low here, both for the Fed and I would say for macro community. We definitely have empathy for a softening labor market. So this is how we've been leaning with rates for the second part of the year so far. But at the moment, it's not very clear, and it might take some time to clarify. And we have to get through this particular events. And the Fed's going through the same thing. And of course, we saw yesterday headline inflation tick up, whilst core still remains, a little above comfort level. So it's a tricky one for the Fed. And that's why you say at 4% rates, it's neither here nor there. So what do you do with that? I think you need additional information. You need to know what the outcome of the election is going to be, and particularly a bit more clarity on the jobs front. Those are the two most important vectors.
Well, Bostic even saying yesterday that the data basically backed up your idea, Ella, that choppiness is maybe a reason to be patient. But you say that there's a change in this market, that it now pays to be reactive. How do you be reactive, though, when the data itself is confusing and the immediate market reaction isn't necessarily one that you can predict?
Well, I mean, I would have to say that particularly as an investor, my edge tends to be contrarian. So I'm not a good follower. And so I will put that out there. So to be reactive, at least you need to understand the landscape in front of you and back to sort of where is the asymmetry. And if we talk asymmetry, certainly a Republican sweep would offer an asymmetry, as in you can see rates markets priced a little bit higher on that vector, and perhaps equity markets might like that outcome. So, those are probably the scenarios where you can have a bit more clarity. Otherwise, on sort of the highest possible scenarios, as per the betting market, seem to be that we're going to have a divided house, and therefore that might mean actually more of the same. I focus on the cyclical picture and focus on the jobs data. So I think that's how we're going to know, right? So that's why we need this event to be out of the way in order to focus for the next leg in the macro space.
I know we want to focus on what's after that, but Ella, I just want to take us to that week itself, where we have an election. We might not know the outcome in the immediate aftermath. It might take days. And we have a Fed decision, too. Just what do you do that week? What are you telling basically clients, investors? Is it a stay on the sidelines? Is it be reactive? Is it get ready with hedges and just cross your fingers and hope for the best?
Well, hopefully our clients pay us to do better than that, right? Cross our fingers. But I mean, look, I think there's ways in bond markets where you can actually obtain a significant yield over and above through, careful portfolio construction. And so that's what we're doing. So earn a bit of additional yield, a bit of additional carry, but actually balance the portfolio better. So I think that's probably the best way to approach this event risk. And that's why I say it is one of the cases, particularly the first time this year, where it pays to react rather than sort of proactively position your fund. And so with that in mind, we're ready to sort of move with the duration vector. At least we have space. And if your risk is low, you can react more rapidly to the oncoming information. And so to your question, I guess, what do you do? I mean, I guess on a clean sweep, we kind of know what to do. It'd be a bit more risk bullish, particularly if it's the asymmetry of Republican clean sweep, but also on a Democratic one, just slightly different implications for growth. But on the rate side, probably curve steepener actually remains the way to play this scenario. It would be a bit more dollar bullish, particularly on a sort of clean sweep outcome. And so then you can engage with a dollar higher. But I think all of that is just too focused on this particular one event risk. I think it's important to take a step back and realize that there has been weakness in the jobs market aside from the NFP number that we saw this month. And that number as well has a lot of sort of what's the best way to put it? It's a tricky one to ascertain. So one data point is difficult to get a full picture on the jobs data. Therefore, we look at all of the other sort of forward-looking components, and they are flagging some weakness on the jobs market. So that might come to play, I think, as we head into 2025.
Do you care much about earnings, especially with the banks, Ella, and trying to get a read just what credit conditions are in the U.S.?
I mean, we're seeing auto loans and credit card delinquencies rising. Also, credit card use has been coming off. So those are some of the warning signals. And I know because we're all in financial markets, we seem to be all in this bonanza of risk on and soft lending. These are things that worry me. And particularly as a bond investor, we always worry about anything that can go wrong, right? And so those are some of the elements that I would bring. I mean, there is nothing particularly concerning on the lending side from the banks yet. But you do see the other signals that are kind of flashing a bit red here.
Okay, Ella, we really appreciate it. That is Ella Hoxha of Newton Investment Management. Enjoy the rest of your Friday and your weekend. I want to bring you some breaking news. The Nobel Peace Prize has been decided, and it's been awarded to a Japanese group of atomic bomb survivors, that group Nihon Hidankyo. Basically, they are an organization, just to quote the Nobel Prize, which we're looking at the award announcement there in Norway. They're giving the prize for its efforts to achieve a world free of nuclear weapons and for demonstrating through witness testimony that nuclear weapons must never be used again. That's according to the Norwegian Nobel Committee, saying in a statement. And so, again, you're just looking at live pictures there of that announcement of the Japanese atomic bomb survivor group winning the Nobel Peace Prize. Okay, let's get to some other top stories that are trending on the terminal this morning. Warren Buffett has now cut his Bank of America stake to less than 10%. That's now below the regulatory threshold that requires quick disclosures of trades. That selling spree began in mid-July and went through 15 rounds of disposals. Berkshire Hathaway has now raked in $10.5 billion on that. Investors surveyed by Bloomberg are expecting China to deploy around 2 trillion yuan in fiscal stimulus. That's at their briefing on this Saturday. It's equivalent to about 280 billion US dollars. China stocks have posted their worst week since July in choppy sessions on expectations of that stimulus. Porsche is added to the chorus of pessimism coming out of Germany's automakers. It saw sales plunge around 20% in the last quarter to a 10-year low. That drop was led by EVs, with local Chinese brands continuing to grow in dominance. Coming up, we're going to have more car chatter, not just the weakness, but Elon Musk unveiling Tesla's long-awaited self-driving robo-taxi. And later in the hour, we're going to be speaking to Peter Tchir of Academy Securities on that confusing data picture. High jobless claims, but CPI coming in hotter than expected. What do you do with all that? We're going to discuss throughout the hour. This is your brief. It's your Bloomberg Brief. Danny Berger in New York here. Tesla CEO Elon Musk unveiled the prototypes of a much-awaited robo-taxi without a steering wheel, without pedals, called Cybercab at an event in California.
We expect to be in production with the Cybercab, which is really highly optimized for autonomous transport in probably, well, I tend to be a little optimistic with timeframes. But in 2026.
Joining us with the latest is Bloomberg's Oliver Crook. Jessica Carl, Bloomberg Opinion, writing that it's Elon Musk's Cinderella moment insofar that he turned a pumpkin into a robo-taxi, and then at midnight it went poof and it disappeared. Tell us how real this dream of Elon Musk's of the robo-taxi, and when it's likely to even be put into production.
Yeah, well, listen, Dan, you're asking a lot of pointed questions, and there was not a lot of pointed answers on some of those points. So let's just actually go through what was actually presented yesterday. So the Cybercab, as you mentioned, was put out there. It's basically got no steering wheel, no pedals, going to be fully autonomous. This is all about sort of the future of urban transport. It's going to cost, he says, under $30,000. You can buy it as an individual. You could have it sort of working as a fleet, as a sort of Uber-style kind of situation. And they should be delivered, he said, by 2026, joking that, he's often very, very ambitious on these timelines. It'll carry two people, one of whom, as you can see, was Elon Musk yesterday on this sort of Hollywood lot, driving around this kind of invented scenario of the kind of his concept of the future. But there was also the Robo Van, which is this huge sort of van that can carry 20 people. It doesn't even have a windshield. It looks very sort of Blade Runner. And there was, of course, the humanoid robot, the Optimus, that Elon Musk was saying can make you drinks. It can do everything for you, mow your lawn. It could be your friend. And Danny, it could even babysit your kids, he said. Though, even as excited as one might get about the future, as seen by Elon Musk, I suspect people draw the line somewhere.
Yeah, probably robots babysitting kids seems like a fair line, Oliver. Elon Musk said not that long ago that you basically need to be a believer in this dream to be a holder of their shares. I'm looking pre-market. I mean, we're down 6%. I guess not so many believers?
Yeah, so listen, Danny, I mean, this is all about sort of Elon Musk's sort of conception of the future. It's a bit sort of, a fantasy to a certain degree, but the magic of Elon Musk is sometimes being able to bring fantasy into reality, but we should say sometimes. There has been a lot of over-promising through the years, and as you can see, this investor selling off this morning to the tune of about 6%. But for Elon Musk, as fantasy as this sounds, this is really at the center of his strategy. The backdrop here is that the sort of traditional growth engines of Tesla, all of these car sales, they've been falling sort of precipitously, and they said they were going to maybe sort of make a pivot and get a cheaper car to the market. They scrapped that idea, Danny, and they said, really, we're going to go sort of fully into autonomous. So even though it may seem sort of conceptual still at the moment, this is a very sort of serious part of the Tesla strategy going forward, and it's going to be absolutely necessary, Danny, to continue to sort of support that valuation, which is still at about $750 billion.
Oliver, I want to bring things closer to where you are in Berlin. Volkswagen reporting their third quarter sales in China dropping 15%. There are bad numbers from Porsche. We know Stellantis is shaking up its C-suite. Just how in dire straits are German autos at the moment, Oliver?
Yeah. In short, Danny, very dire straits. So we've had profit warnings from all the companies that you've mentioned, right? From Stellantis, we had that sort of profit warning about 2 weeks ago, which is what has led Carlos Tavares to have a massive shakeup across the entire company. New CFO, new COO, new COOs in North America and China, new brand heads. That all came basically overnight. And guess what? The investors are still selling shares. Stellantis has lost a fifth of its value since that profit the profit cut. BMW, Mercedes, Volkswagen, same story. And really, when you drill down into the numbers, Danny, because we got the delivery numbers over the last 24 hours from all the German car makers, it's really a China story. We had BMW, for example, sales in China dropped 30%. Danny, when you put that into context, that is BMW's biggest market, losing a third. That is absolutely huge.
Yeah, and I mean, that's even without any discussion of what robo-taxis are going to do to the future of all these car makers. Oliver, we really appreciate your time this morning. Bloomberg's Oliver Crook in Berlin. Okay, coming up, we're going to bring you some of the headlines around the world. That includes Tehran's warning to the U.S. allies in the Gulf. All that to come on your Bloomberg Brief on this Friday morning.
The SBA is pretty right at the edge right now. And I think the Congress should be coming back and moving on emergency needs immediately, and they're going to have to come back after the election as well. Because this is going to be a long haul for total rebuilding. There's going to be a need for significant amounts of money. We're already underway at trying to calculate what the cost will be because we don't want to mislead anybody. We want to make sure all the costs are able to be covered.
That was President Biden on the need for an emergency congressional response to Hurricane Milton. Let's go straight to ABC's Rena Roy, who joins us live from Florida. Rena, perhaps the worst of expected was avoided, but still not without damage. What's the latest there?
Yeah, Danny, well, I can tell you that here in St. Petersburg, this is one of the hardest hit areas. In fact, you can see that there's a crane into a building right behind us. And there are really scenes like this all across the state after Milton made landfall as a powerful Category 3 hurricane on Wednesday night just south of Tampa. And since then, there have been hundreds of rescues with catastrophic flooding across the state. The Hillsborough County Sheriff's Office going door to door on boats and in high water vehicles, rescuing more than 725 people. Nearly 500 of them were rescued from an apartment complex in waist-deep water. That building was not even in the evacuation zone. In Tampa, a mother and son even used their fishing boat to rescue people. In central and eastern Florida, it was really those deadly tornadoes. Milton spawned 38 of them. Hundreds of homes destroyed, at least 6 people killed. And as you just heard, President Biden, he is now calling on Congress to immediately pass funding for disaster aid. Danny?
Rena, what do we understand about the cleanup effort and just, you mentioned some of the rescuing, but the aftermath? I mean, you're looking at businesses, even the scenes just behind you of that crane into the building, quite shocking. What sort of resources does Florida have available to it to get the effort on the ground and get things back to normal?
Yeah, well, there is no doubt a very long road ahead here. The governor says this is one of the largest mobilizations of resources in state history. Local, federal, and state officials, they're all really working together here to try and give the people of Florida what they need to get back on their feet. We know that FEMA is also on the ground in force here. They have been offering resources like search and rescue teams, power restoration crews, and high water vehicles. Danny?
Rena, thank you so much for your coverage of this all week. That is ABC's Rena Roy. Stay safe out there. Okay, let's get you some of the front page news this morning, just a look at what's making headlines around the world. First up, on the New York Times, they lead with this. Speaking of the hurricane, that bizarre falsehoods about Hurricanes Helene and Milton have disrupted the recovery efforts. There have been claims spread on social media, and that's despite attempts by scientists and government officials to debunk them. Experts warn disinformation and conspiracies can rapidly escalate into the real world and distract from aid. Part of the issue has been telling people, yes, there's $750 in aid, but there is more than that. Former President Trump also spreading some of that disinformation, too, about some of the aid going to immigrants, which, again, is not true in terms of FEMA. Next up, on the Wall Street Journal, Iran's secret warning to U.S. allies: do not help Israel or you are next. Tehran has been threatening to target oil-rich Arab Gulf states and other American allies in diplomatic back channels. The Islamic Republic has also warned that it would respond to any retaliation from Israel with devastating hits on Israel's civilian infrastructure. The Israeli cabinet met last night. Again, it's still a market that is in wait and see to see what will happen in terms of retaliation. Oil prices lower this morning. The Washington Post has this: Obama, former President Barack Obama, admonishing black men for hesitancy in supporting Harris. He made the appeal to black men specifically at an unannounced stop at a Harris campaign field office in Pittsburgh. For anyone that listened to this speech, it was quite fiery for those who heard it. Harris has also been struggling to mobilize the key demographic. Obama also in that speech basically saying that some of the disinformation that's been spread about Hurricane Helene really damaging and really pointed language about President Trump. Well, it is the hurricane, it is strikes, it is confusion in the data that has led to confusion in this market. The bond market yesterday rallying Today, it is the opposite. Two-year yields, though, are still below 4%. We priced in more Fed cuts after yesterday's data that saw claims come in higher. It is the concentration of this market, the labor market data instead of the CPI. At this moment, a less than 20% chance that they do not cut at all. It's still the expectation is that they will cut in the next meeting. 10-year yields, those higher by 2.5 basis points. 30-year yields, 2.7 basis points. So it is the long end of the curve that is under pressure. Meanwhile, equities fall, on track to fall for a second consecutive day, coming down from the highs that we saw posted earlier in this week, down 0.2%. The declines this morning are being led by Russell 2000 futures, which are down 0.3%. The Bloomberg Dollars Index also taking a breather. It was on its longest winning streak since 2022. Coming up, we're going to catch up with Peter Tchir of Academy Securities just on that confusing data and what you do with it, and maybe why the market was paying too much attention to jobless claims data that have been skewed by the market, skewed by things like the hurricane claims from North Carolina in particular picking up. Good morning from New York. This is Bloomberg. From our global headquarters in New York, welcome to your Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Autonomous dreams. Musk unveils Tesla's new robo-taxi, estimating production may start in 2026. The data puzzle, jobless claims at a one-year high and hotter than expected CPI. The Fed's next move remains in question. And earnings season kicks off. Big banks will report their numbers, JP Morgan and Wells Fargo, before the bell. It's a confused market driven by confused data in a period heavily influenced by storms and strikes. Equities this morning are lower after lower session yesterday. Russell 2000 futures lead those declines. We're going to get some of the banks reporting today, JP Morgan and Wells. When it comes to this bond market, maybe more concerned by higher claims data. Yields go below 4% for your two-year yield, though we are edging higher this morning, about 3 basis points for your 10-year yield. Now, that front end of the curve, just to zoom in on that, we got the jobs data yesterday, the claims data, and CPI. It was volatility initially to figure out what this market wanted to do. But ultimately, two-year yields did end the day lower yesterday, below 4%. The concern, higher claims data coming in above 200,000. And maybe it was distorted, but it was what the market was questioning and concentrating on. Joining us now is Peter Tchir, head of macro strategy at Academy Securities. Peter, you say it's a mistake for the markets to concentrate on the jobless data. Why?
Because I think last Friday's non-farm payroll was good enough that the Fed has really just looked at jobs. And now I think they have to start looking at inflation. And the inflation data, it's okay, but it's not great. And you start looking, okay, if China's stimulus is successful, what happens there? Oil's coming off a little bit today, but we've got geopolitical tensions everywhere that's putting pressure on oil. And then finally, I think the hurricane rebuilding is actually going to be inflationary for the U.S. One, it's disrupted some supply chains, but you're going to have a lot of insurance checks coming in. People want to fix whatever got broken. I think we're going to see a bout of inflation coming into the fourth quarter.
If we get a bout of inflation, is this going to be one of those periods like we had to start the year to say, okay, the Fed's just going to wait and see, they're going to ignore it? Or is it so bad that, especially adding in an election, a potential Trump presidency with more tariffs, as some have claimed, maybe it's even hikes on the horizon with all those factors?
So I don't think it's hikes. I think we get 25 bips in November. I think they're kind of set on that pace, and it would almost be embarrassing for the Fed to say, we did 50, now we're doing 0. So I think they get 25, but that puts us on this pause, and it is going to be data dependent. But I do think, one of my views has been we really skew the data here because we use these 5-year moving averages to do the seasonal adjustments. We overstate jobs in January, February, March. We understate them in the summer. So it was not as good in the first quarter this year as it looked. It wasn't as bad over the summer. So I think we kind of meander through. But if the jobs data stays okay, inflation ticks up, the Fed's going to have to watch that.
It's interesting you say they're going to go 25 because it would look bad to pause. That maybe it looks like a mistake. Raphael Bostic gave an interview to the Wall Street Journal yesterday, and he said this choppiness to me is along the lines of maybe we should take a pause in November. I'm definitely open to that. Do you think this is Bostic, and maybe others will follow, trying to set the stage to say, it's just because of the choppiness of the data. We didn't make a mistake, but we should pause.
So I think they're trying to set that up, but I think that's why we get 25, right? So they've certainly talked the market out of 50, which I thought was ridiculous. Like the market thought it was going to be 50, 50, 25. So the market's been moving my direction. I think the two things that are going to happen is one, fewer rate cuts up front. So we get 25 in November, probably a December pause. The other thing is they're starting to talk about the neutral rate. And I think the neutral rate's going to be more like 3.5%, 3.75%. Because if you look at it, right, we've been above 5% for a year and a half. The economy barely nudged down. So this thought that the neutral rate is somehow 2.875 or 3%, I think, is wrong. And as they analyze this, what we're going to realize is fewer cuts next year, and the terminal rate's going to be much higher. I think it's going to be at least 3.5%. That's going to weigh on bond markets. So I think the 2 years is probably okay, just around 4. I think we get back to 420, 430 on the 10s. And what's starting to make me nervous is I feel like the bond market, the liquidity is not what it once was. Everyone gets positioned one-sided, and now we're starting to move higher. I would have thought yesterday, after the 10-year auction, 30-year auction was done, we could move back towards 4% on 10s, and here we are at 409. So I think we could break much higher on 10s.
So we could break much higher, and then you've laid out all these risks on the horizon, specifically geopolitical tensions, and I know you have some of the brightest minds at Academy Securities, former generals analyzing this. What is the risk that you all see that there's a disruption in oil production and could lead to what you're talking about, that break higher?
Yeah, so we've got 20 retired generals and admirals who serve as our geopolitical intelligence group, so it's amazing that I get to work with them. And I think we're looking, and I think you're seeing it in the media, that Biden is trying to slow Israel down, but I think from a pure military standpoint, so ignoring everything we can on the humanitarian side, if you're looking at it from a military standpoint, Israel has a lot of things going in their favor. They have the proxies on the run. Iran has kind of shown itself to be a weak leader of the proxies. So we think they're going to continue to push on the proxies because they no longer trust Iran, right? They sent 180 ballistic missiles, nothing really hit anything of importance. And maybe they go after Iranian oil fields, right? That's the next thing, right? How do you stop the funding? Now that they've got the people on the run, so we think that's in play. And Russia and Ukraine's always there in the background. That's heating up. And there's a reality that maybe Putin or someone's going to want to create inflation ahead of the election. So I think oil is the way to play this. I think you want to be long at these prices still and buy oil. And I do not think treasuries are going to work as this quote-unquote flight to safety. Because what's happening right now is every time you get a geopolitical event, maybe you get a brief rush to treasuries, then people realize, oh my gosh, global spending on military is going to have to increase. Domestically, foreign, that's just going to put pressure on yields across the globe.
Not to mention the inflationary impact of higher oil prices. But, okay, so there could be oil disruption from Iran, but the big threat that everyone talks about is disruption in the Strait of Hormuz. Is Iran attacking that Gulf supply? How big of a risk is that?
So I think from our military people say it's not a huge risk. They can disrupt it, but we have the tools, the ability to, sweep it out very quickly. So, but it would escalate, or there'd be the fight. But I do think you're right. We are much more focused on oil transportation than the oil fields themselves, right? Damage to the oil fields tends to be fixable. It's easy. We're looking at really the transportation hubs, the ports. I think that's where the real danger lies. And
so what oil prices are we talking here? Because it's the scenario, again, where oil goes higher and then you don't get that hedge of treasuries. I find that really interesting. So how high could oil go in this scenario?
So we kind of view, and again, we've been trying to play it in this range, but once you get near 90, I think that's about it, because the Saudis will flood the market at, we believe somewhere above 90, that's where the Saudis really step in. They keep oil supply going. So again, so long as they can ship it out there, and so far that's not our base case, that they won't be able to ship it. So kind of 85 to 90 is where we kind of lighten up on hedges. 75 and below is where we buy these hedges.
Peter, before we let you go, we're about to get some of the big banks reporting. You mentioned bond market liquidity, but you've been excellent on stock market liquidity too, and some of the outsized moves in single name stocks. How are we set up into this earnings season?
It feels like we're going to continue to have these outsized moves. Like, you look at earnings and like, oh, that should be 2%, and all of a sudden the stock's up or down 10%. And sometimes it's both, right? It's up 10% initially, down 10%. So I do think there's very little depth of liquidity. I think all these algos drive things. I think that's one thing that happened yesterday morning. The algos are still kind of set to trade off the jobs data. They got it a little bit wrong, and I think over the next coming days or weeks, they'll start being re-triggered to trade off the inflation data. That's when I think this pushes through, and I think people are going to be surprised that China, the initial stimulus package looked meh. They are going to continue to push this. We think the CCP, to stay in charge, needs the economy to do better. They need to buy time for their Made by China strategy to grow. They're going to want domestic consumption to work. So we're going to see more and more stimulus out of China. So probably right now, my favorite stock market own is China via FXI, probably.
So I'm guessing you're going to be watching this Saturday?
Of course.
Okay, Peter, we'll get your take after it. Peter, thank you so much for joining so early this morning. Enjoy the rest of your Friday and your weekend. That is Peter Tchir of Academy Securities here on Bloomberg Brief. This is Bloomberg Brief. You're looking live at the principal room. Coming up, Priceline CEO Brent Keller. That's at 10:30 a.m. in New York. This is Bloomberg. It's Bloomberg Brief. Danny Berger in New York. We're somehow 25 days until the U.S. election. It's wild. Kamala Harris defended her record on immigration and health care in a town hall in Las Vegas. Donald Trump, meanwhile, is planning a string of campaign stops in states that he has little chance of winning, speaking at the Detroit Economic Club yesterday. Joining us now is Bloomberg government reporter Kate Ackley. Kate, what was the split screen we got of Harris and Trump yesterday?
Well, taxes and economic policy were front and center for both of them. As you know, this is an election where the economy, jobs, inflation, how much we pay for things is really right at the top for what people are concerned about, what voters are concerned about, especially in those battleground states. You saw Vice President Harris in Nevada talking about inflation and healthcare, immigration. You saw former President Trump in Detroit talking about offering a new plan that would sort of give a tax credit for car loans. Talking to Detroit about trying to help the auto industry.
Yeah, Kate, we actually have the sound to that. Let's just take a listen real quickly of what Trump was talking about for the car loans on the on the campaign trail.
Today, I am also announcing that as part of our tax cuts, we will make interest on car loans fully deductible. This will stimulate massive domestic auto production and make car ownership dramatically more affordable for millions and millions of working American families.
Kate, at this pace, there's going to be no taxes for anyone at any point. And you kind of understand that from Trump's pitch. I just wonder what audience he's going for, not just with these tax proposals, but in holding campaign events in places like Coachella in Colorado, at Madison Square Garden in New York, in the lead up to this election, places which are solidly blue.
Well, first of all, any of these tax provisions, these tax proposals, are most of them anyway, would have to get through Congress next year. So these candidates can, sort of propose all kinds of ideas. Will they resonate on the campaign trail? Maybe with swing voters. That's obviously the aim here, but they would have to get through Congress. And you got everybody, you got all the big, sort of surrogates hitting the campaign trail on, both sides. And you mentioned Trump going to Colorado tonight for a rally, and then later this month, Madison Square Garden in New York. Really trying to get into those blue states that he does not have much of a chance of winning.
Yeah, meanwhile, you can see there Obama was in Pittsburgh making a surprise stop with Harris, using really strong language. Kate, thank you so much for that. That is Bloomberg Government's Kate Ackley. Elsewhere, Tesla CEO Elon Musk unveiled the prototypes of a much-awaited robo-taxi. No steering wheel, no pedals. It's called Cybercab. He spoke at an event in California.
We expect to be in production with the Cybercab, which is really highly optimized for autonomous transport in probably, well, I tend to be a little optimistic with time frames, but in 2026.
Not just California, but at Warner Brothers Studios. Joining us now is Bloomberg's Global Autos editor, Craig Trudell. He says 2026. He kind of makes a joke about meeting deadlines. How seriously should we take this one, Craig?
I think we should take him at his word about being a little bit overly optimistic. I mean, just for a sense of how optimistic he can be. Some people were hoping that maybe last night we would see the next generation Roadster, and we saw a prototype of that way back in 2017 that was supposed to come out a couple years later. That is still not in production. So, and that is, of course, a car that, we humans will drive. So this is a CEO who is absolutely, superb at getting people excited about the future. But in terms of delivering on particularly self-driving predictions, he's really had a difficult track record there.
Well, to that point, Craig, we were just showing the Tesla share price down more than 5.5%. It was only in the beginning of this year that everybody was telling Elon Musk, you need to concentrate on having affordable vehicles, enough with this robo-taxi and Optimus dream. Is that still the case? Is this still an investor base and analyst community that wants to hear more about affordable vehicles?
I do think it's a bit split, right? Where we're seeing the auto industry, run into some trouble. We've seen profit warnings left and right from, the sort of old-fashioned metal-bending car makers. And Elon isn't very interested in competing with that. And there are some who say, you know what, he's doing absolutely the right thing by sort of zigging while the rest of the industry is zagging. But there are others who say, look, if this is a growth company that isn't growing, which it may not this year, it may actually sell fewer vehicles than it did in 2023. There are some who are very uncomfortable with the fact that he talked years ago about offering a $25,000 electric vehicle, and that's nowhere to be found.
Craig, we also heard from the former President Trump yesterday, and he was very strong in his language in Detroit, talking about Chinese vehicles, stopping them from coming in the U.S. As part of that, he said the autonomous vehicle, we're going to stop from operating on American roads. Remember this. Maybe not clear whether he was talking about Chinese cars, but it comes at a time when Elon Musk has been getting closer to Trump and campaigning for Trump. How do we understand what a Trump presidency might mean for Tesla?
I think these are two characters who can sometimes, their words, you have to try to do your best to parse them, but it's not always clear just how much stock you should put into what they say. I do think that Trump has maybe sort of tempered his criticism of electric vehicles since Musk has endorsed him and become one of his biggest benefactors. I do think it was very interesting, though, that within this bit of criticism of Chinese vehicles and the Biden and Harris administration's handling of them, that he sort of threw this aside at autonomous vehicles and sort of doubted whether people like them or are interested in them. I'm not sure whether he knew that Musk was putting on this event a few hours later.
Yeah, unfortunate timing. Craig, we really appreciate it. Bloomberg's Global Autos editor, Craig Trudell. Okay, in other company news, big banks are facing tough questions as forecasts for earnings declines escalate. JP Morgan, Wells Fargo, they're going to kick it off with their results 7 a.m. today. JP Morgan President Daniel Pinto, in an attempt to reset expectations, spoke at a Barclays Financial Services conference last month.
The analyst consensus is a drop in NII of 1.5 billion, from 91.5 to 90. That is a bit, is not very reasonable because the rates expectations is lower by 250 basis points. So I think that number will be lower.
And that statement there led to lower share prices for JP Morgan at the time. Joining us now on What to Expect is Bloomberg's Shonali Basak. Shonali, after Pinto speaking there, just where is the bar for JP Morgan?
It is pretty high. If you think about it, you remember last quarter, they bought in returns of tangible common equity of 28%. Just stunning. But you see the market becoming more discerning because of a very uncertain outlook for net interest income. Now, it is the first quarter, right, that they were reporting after those Fed rate cuts. And what's interesting is the range of dispersion there is both between how many cuts we actually can get and how that would feed through to net interest income and how it would impact different banks differently. So for the sake of JP Morgan, for example, one reason that you saw Morgan Stanley really downgrade them is because they believe that they would be impacted somewhat negatively by that net interest income story, partially because they have so much of their income that comes from floating rate. So you will see how this plays out, but the guidance today for the rest of the year, if there were any upside there, that would be, of course, very, very positive, but people are watching credit quality very closely, too.
Well, yeah, to that point, because at that conference in Barclays, you had Ally Financial warning auto delinquencies are creeping higher, same with net charge-offs. Should we assume that that is a one-off, that is an Ally Financial story, or might that be more present in the earnings this quarter?
So it will be an interesting quarter across the board for all the banks for that reason, because we know that Ally Financial is not Fortress JP Morgan, right? It's not the same texture of loans under the surface. And if you take a look at kind of the FICO scores, for example, Bank of America kind of lays this out very, very clearly in presentations alongside earnings. JP Morgan, you have to go through other filings. But, you know, these are very generally safe customers already. And so you think about the hit that's being taken here. Banks had been quite conservative the last couple of of years. If we do see that tick up at JP Morgan, the deterioration here, you would see that impact across the banking system. JP Morgan has a very, very large credit card book, and so that is something consumers are watching very, very closely. As you know, the economic data has been very, very mixed, and so that will be a bellwether. We'll see how that plays out. But for JP Morgan, more so, one fun fact for you, Danny, I took a look at just last quarter alone. In net interest income, it was more than double of net interest income what they bought in total investment banking and trading fees. So that's how much that profit line really matters at the end of the day.
We're also going to get Wells Fargo today. What are you looking out for there?
Similar story, different kind of loan book here, and they don't have that massive behemoth credit card business as JP Morgan does. And so we have seen them really suffer from the lending business over the last couple of years. The question is, where do they drive that net interest income from? You know, the other part of the story that we didn't talk about was the yield curve. The steepening is good for these banks. And so do they adjust their expectations based on the new projections?
I mean, it's so interesting to hear you talk about the yield curve making a difference for them, Fed cuts, and we kind of just don't know what this economic environment is. When it comes to forecasts from these banks, what does it look like in an environment where they just don't know, and then not to mention a U.S. election, which can completely change things in a month's time?
I think one thing that'll be interesting, this probably is a little less applied to Wells Fargo, though Wells Fargo has been trying to get more banking trading income here, more fee income. You had more volatility in the quarter than one might expect. And so did their trading desks really benefit from that or not? Because sometimes when volatility blows out that much, it's considered gapping volatility, where clients shy away rather than dive into the market. A little bit of a fun fact, too. Apollo put out a very interesting note, Torsten Slok, this week that said prime brokerage activity is starting to create a financial stability risk. And the reason that's so interesting as well is because these prime brokerages, the way that they have been kind of squeezing out that extra dollar is through their lending revenue. Goldman in particular has been leaning very, very into lending to their big institutional clients to drive that prime brokerage revenue and therefore to drive the trading revenue.
Well, it'll be an interesting quarter, to put it lightly. Sonali, thank you so much. Tune into Surveillance. Sonali will be breaking down those numbers 7 a.m. That is our financial correspondent and Bloomberg Open Interest co-anchor Sonali Basak. Okay, coming up, we're going to set you up for your trading day. We're going to get you, Mitch, along with those earnings. This is Bloomberg. It's your Bloomberg Brief. I'm Danny Berger. Let's get you set up for your trading day on this Friday. Bank earnings are going to kick off with Wells Fargo and JP Morgan. They'll both report before the opening bell at 7 a.m. We're also going to get more economic data, PPI at 8:30 a.m., UMISH sentiment, that's at 10 a.m. And then plenty of Fed speak. It's been quite the week for Fed speak. We're going to get Austin Goolsbee, Lori Logan, and Michelle Bowman. Just some stocks to keep your eye on this morning. Tesla, we had that robo-taxi announcement. Disappointment, shares lower this morning. Uber, that's also rising off the back of Tesla's announcement. Meanwhile, Stellantis, they've ousted their CEO. They're trying to gain investor trust and stabilize its deteriorating business. Okay, that is it for your brief this morning. Stay tuned for Surveillance. That's up ahead.